So the prior example assumed that we were going to sell, or that we were able to sell, the discontinued component in the same year that the decision to discontinue it was agreed upon by the board of directors. Now, suppose that the criteria to dispose of a component, we meet all the conditions. It is separate. We are able to separate the revenues, expenses, the assets, and the liabilities of the discontinued component from the ongoing portion of the company. It is a strategic shift. So we meet those criteria, which are very important to remember. But the sale is not completed until the following year. So if the sale is not completed until the following year, then at the end of the year that we've decided to sell, but have not yet sold it, we have to check it for impairment. So we only check for impairment, only checked when we've met disc-op criteria and have not disposed of it. So again, this is the case in your practice problem where the Züchter decides, hey, I don't want to do car restorations anymore. They are at the end of the year. They haven't yet sold it yet. There is a check and an application of impairment in that problem. If there is an impairment, right, then we have to include this in the effect of the discontinued components operation on our overall net income. So rather than a gain or loss on disposal, we will have an amount of impairment. Now, impairment is a process that can be applied to any asset in the company. In this case, we're applying it to a portion of the company overall, but we can also apply it to any of our ongoing assets. We could impair a piece of equipment that we're still using in our ongoing operations. We can impair the goodwill of our company, that is an intangible asset. We could impair a patent that our company is still using in its ongoing operations. So impairment does not just apply to discontinued operations, but when it does, we have to make sure to put the impairment that is associated with the discontinued operation down here below the line. It occurs when the fair value of net assets less cost to sell is less than the book value of the components. So what we're doing here is looking at what is the book value of net assets, because remember, again, that's how we judge the value. That's how I judge the value of what I gave up, is the net assets. When we're talking about a small business in and of itself, we're talking about a business that has assets and liabilities. So we're looking at the book value of those that we have on my balance sheet versus the fair value of net assets. And remember, book value and fair value are not always the same. One of the big reasons why that is not just because, for example, property, plant, and equipment is recorded at a value that is very distinct from its fair value, but also there are just a lot of assets of value that are not able to be reported on a balance sheet. So remember, some market niche, some sort of a synergy of assets, such that like I have this one asset that's worth 50 and I have this other asset that's worth 20. Well, to say that overall they're worth 70 kind of ignores the fact that maybe when I put these two assets together, their economic benefit is more than just the sum of those two numbers. The idea that it's more than just the sum of those two numbers is not captured in book value. The book value of those two assets would be 50 plus 20, 70. But the fair value of those, when I think about, oh, but then they combine to create a product that neither alone could create, then maybe their fair value is worth 100 or 120. So there's things that are not recorded in fair value from our book values, besides just the fact that we measure certain assets and liabilities at amounts that are not fair value. So we'll look at these two things, and when we have cost to sell, we also need to deduct any cost to sell. Now let's think about that. So if I have, let's just reduce it to a single asset to make it a little bit more easy to consider. So I have a car, right? I have this car at its historical cost less accumulated depreciation. Well, that certainly won't equal its fair value, right? But so the fair value is what I could sell it for. So maybe I could sell it for $10,000, but in order to get it sold, I have to get someone to sell it on my behalf, and I have to pay some commission, right? So that's a part of the cost to sell. I'm not going to be able to get all $10,000 because while that's its selling price, I'm going to have to pay someone a small kickback, maybe $200, in order to sell it on my behalf. They're my agent. Well, then the true fair value of this car to me is not $10,000 because that's not what I'm going to get. I'm only going to get $9,800 because I need to deduct those costs to sell. So that's why when I'm considering what it is on my books versus what I'm going to get, I have to deduct any of those transaction costs that occur. The difference between these two, first we have to decide, is the book value of assets greater than? So if I look at these two and I decide that it's greater than, then this implies that I need to impair, because the book value is greater than the fair value. Now, if it's the other case, that the fair value I'm going to receive is more than the book value, then I don't have to do anything. So note that this no accounting adjustment necessary occurs when I have a book value, say, of $8,000, but I'm going to get less cost to sell, $9,000. I'm not allowed to record that adjustment because that would involve me recording an appreciation in price. But if that inequality is reversed such that I have book value of net assets at $9,000 and the fair value less cost to sell is $8,000, then I do have to adjust it down. I have to record a $1,000 impairment loss. I have to bring the book value of my net assets down to the fair value. And this whole item is an instance of conservatism, right? I'll record reductions in value. I will not record increases in value. Right? So once I decide whether or not to impair, then if I have to impair, the difference is the amount of impairment loss that I'm going to recognize. And again, like I said, no gains may be reported. That's that whole conservatism outlook. So let's look at another example where we're completing the decision to dispose and the sale in different years. So we have a different company here. We have Hillian decided in 20X6 to dispose of Bacchus. That was a qualifying component. It was not only separable, but also was a strategic shift. During 20X6, Bacchus had pre-tax loss of $40,000. On 1231X6, the book value of the net assets was $200,000. The fair value less cost to sell is $130,000. So we have book value of net assets, we have book fair value of net assets less the cost to sell. If Hillian is unable to dispose of this discontinued component, record the appropriate disclosure on the income statement, assuming a 40% tax rate, and income from continuing operations of $370,000. So again, this income from continuing operations, we'll assume that that it is after tax. And that way we don't have to strip any more taxes from it. We have income from continuing ops. That's where we're starting, $370,000. Then we have a discontinued operation. Segment that we want to disclose. We have to have the profit or loss. It says it had a pre-tax loss of $40,000. So if we have a pre-tax loss from my discontinued operations, remember again that this is the revenues less the expenses of that discontinued operation of $40,000. And now I'm wanting to separate out the tax effect, which with a 40% tax rate would be $16,000. Then that means that the remaining amount, the after-tax amount, would be $24,000. So this is what I would report as the loss portion after tax. I would report that it's net of tax of $16,000. That way we can work backwards to the pre-tax loss. Now, we didn't sell it. We were unable to dispose of that discontinued operation. Well then, if we're unable to dispose of it, we have to check for impairment. It says that the book value of those assets was $200,000. The fair value less cost to sell was $130,000. So we look at the book value, which is $200,000. Then we think about the fair value, and again, these are of my net assets. This was 130. We have the case that the book value is greater than those, which implies that we want to apply impairment. And the impairment that we need to apply is just the amount that would take $200,000, which is currently recorded on the books, and make it $130,000. $130,000 is not recorded on the books. This is just our assessment, our appraisal of what the fair value of those assets are. So in order to reduce that, I would need a $70,000 impairment loss. And that is just the difference between the two. Now this is pre-tax impairment. In order to get it after tax, I would need to again strip out the tax piece. 40% of 70 is 28, which leaves us with 42 after tax. So I have a $28,000 tax effect and a $42,000 after tax loss. Remember, impairments are always losses. If you're recognizing a gain on impairment, you're doing something wrong, because conservatism tells me, hey, I cannot recognize instances where the fair value is greater than the book value. So we got an impairment loss on our disc op, and it's net of tax of $28,000. Which gives me the $42,000. I combine those two, and that gives me $66,000 of an income decreasing effect from my discontinued operations. That's 66, written a little poorly. Net income as a result of these discontinued operations would be the 370 minus the 66. And that turns into $304,000 of net income. right? So that is in the year that we decide to dispose with the application of impairment. Now, continuing from this example, Hellion had a net loss from operations of from January 1st to the day of sale, May 17th, of $8,000. On May 17th, Hellion sold Bacchus for $150,000. We now want to complete the discontinued operations section for 28.7 income statement and assume that this company had income from continuing operations of $390,000 and a 40% tax rate. Again, we'll assume this $390,000 is after tax. So we start again, income from continuing operations, that is after tax of $390,000. Now we have our discontinued operation. Got to switch over. We had net loss from operations of $8,000. Again, we'll assume that that's pre-tax. And I will always specify exactly what you should assume on the test. And the problems. I just don't do it in these as well because I can tell you. $8,000 with a 40% tax rate. Well, then that means 3.2K is taxed, or a tax savings in this case because we're talking about a loss, and that the rest of it, which would be 4.8 thousand, would be after tax. So our loss from Discops net of tax would be the tax effect is 3.2 thousand, and our after tax loss then is 4.8 thousand because that net of tax, that tax savings helps us reduce some of that loss. They sold it for 150,000. Right? So again, I got 150,000. Now the question becomes, what is the book value of net assets of this company? Be very careful. One of the most common problems, and this is where you should highlight, underscore, whatever you have to do that keeps your attention on this, is that students want to grab 200,000, but after we apply impairment, this is no longer $200,000 of a book value because we recognized an impairment loss and we're reducing it by $70,000. What that means is essentially, it helps if you just think of it as a journal entry, and this is simplifying it a bit, but when I'm making that adjustment, and this is in your practice problem, I show you the adjustment that happens. I'm debiting that loss for its pre-tax amount, and I'm writing down an asset of my discontinued operation. So it's no longer $200,000 of a book value. If you think of, the disc op as a single asset, which isn't typically, it's not the case in real life, but it helps in this case to think about it. It was at 200,000, but I just credited it by 70,000, and so now its book value. Remember, I was trying to make its book value equal its fair value. And that's what that loss does, is it drives down the book value. So I got 150,000 and I gave up my discontinued operation, which its net assets are now at a value of 130,000. So the gain, because I got $20,000 more than I gave up, the gain on disposal net of tax. The pre-tax amount is $20,000. I strip away an $8,000 tax effect. I have $12,000 remaining after tax, $12,000 pre-tax, or sorry, tax effect, $8,000. I sum these together, 4.8 and 12,000. This is a loss, this is a gain. And so I end up with 7.2 income increasing because this gain on disposal outweighed the loss from the operations. And then I have 390 plus 7.2 gives me 397.2 thousand. Okay. So I separate this out in 2 years when I don't sell in the year that I decide to discontinue. When I haven't sold it, I have an impairment. When I sell it, I don't have impairment because the gain on disposal tells me, hey, I sold it. You will never have both a gain / loss on disposal and an impairment in the same year. You only apply impairment when you haven't sold it yet. Okay. And then here's a little something to think about. What would have happened if we didn't apply impairment? So would we have recognized more or less income resulting from the discontinued operation over the 2-year period? And I want you to kind of dig into this and think about it a bit. Really, in order to do this, the best way would be thinking about, well, what does applying impairment do, right? How does it impact the gain or loss on the sale of the division in the second year? Like I was saying, it really forces us to focus on a piece of this that if I impair it, this reduces my book value from 200 to 130. So rather than selling something at 200 and giving up a book value of 200, I've already impaired it, and now I'm only giving up something that on my books is $130,000. So yeah, I strongly encourage you to think about that. I'll ask you in class when we're scheduled to discuss discontinued operations, and yeah. Anyway, thank you.